domain experts. That's what they're here for.
Oh, stop it. Why does... Okay, right, that's now on. Right, got it. Oh, hold on. I'll turn that off.
My terminal is saying, my Zoom
Right.
app is saying now
Okay.
streaming live on YouTube.
Okay, 5, 4, 3, 2, 1. Go, Dominic.
Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, What Should Asian CSDs Do About Tokenization? Is it safe for CSDs to go project of tokenization? Since I started work on this event, I've had 2 conversations about the topic that have left a lasting impression on me. One was with a senior figure in the global CSD industry who explained to me that CSDs are really struggling to make the business case for tokenization. The other conversation was with a millennial who argued forcefully with me that NFTs had proved tokens are a villainous scam and begged me not to fall for them. Now, at one level, of course, these objections are familiar. The whole history of innovation is littered with similar reactions to new technologies. In Telegram Company Memorandum of 1876 that declared this telephone has too many shortcomings to be seriously considered as a means of communication, the device is inherently of no value to us, now appears on postcards and T-shirts. Likewise, many innovations we now take for granted were stigmatized or even demonized at first. The printing press, electricity, roasted coffee, margarine, and even in our own time, transgenic crops, IVF, artificial intelligence have all been denounced as the work of modern Victor Frankensteins. On the other hand, it does not resolve the argument to say that the CEO of BlackRock has predicted, as he has, that the next generation for markets and the next generation for securities will be tokenization of securities, or that the CEO of BNY Mellon believes that over 10, 20, 30 years, we will see more assets exist in tokenized form and managed on blockchains, and that we, i.e. BNY Mellon, want to be part of that revolution. The confidence of industry leaders doesn't prove that tokenization will happen any more than Jamie Dimon's verdict on Bitcoin in 2017, namely it's a hyped up fraud, settled the future of cryptocurrencies. There is a natural tension between innovation and incumbency, between continuity and change. And frankly, the incumbents are in a much stronger position. They have customers, revenues, and capital, and that gives incumbents something innovators are inevitably short of, namely time. In the case of tokenization, these forces of inertia are more powerful than any of the promises made by tokenization enthusiasts to cut costs, conquer new asset classes, and democratize investing. If you have status, or wealth, or prestige, economy, expansion, democracy, these are not benefits, they're costs and they're threats. Those who quote Joseph Schumpeter on creative destruction are apt to forget that in the same passage, the great economist of entrepreneurial capitalism warns that incumbents do not accept their destruction passively, that they can and do fight back. And one of the ways in which they fight back is by preventing new technologies from getting out of the sandbox, or the proof of concept, or the pilot test, or the in-house laboratory, or the patent lawsuit, and into the marketplace where network effects can do that work of creative destruction. Incumbents will use law and they will use regulation. And this is apposite at a time when tokens and indeed cryptocurrencies are being brought within the scope of law and of regulation. Incumbents will use both to defend their position. Institutions are naturally conservative. Continuity is what they do. And it's hard for regulators, even when they know it is a large part of their responsibility to encourage innovation and adaptation, to resist the lure of continuity themselves. Just look at how adroitly incumbent banks are denying non-banks access to central bank money settlement systems. Nor can regulators ignore the often sorry history of innovation in finance. Financial markets have a strong track record of what Mariana Mazzucato has called destructive creation. Whether we like it or not, this is the way the world works. which is why there is a growing consensus around the world that those who expect tokenization to suddenly and radically disrupt the status quo in the capital markets are likely to prove mistaken. We are not, says the consensus, going to jump anytime soon from the old technological paradigm of centralized intermediaries, Web 2.0 if you like, to the world of decentralized peer-to-peer markets, or Web 3.0. On this view, tokenization is not going to overthrow the financial markets of today any more than the internet killed television, or television killed radio, or radio killed the newspapers. Instead, the innovators and the institutional incumbents are going to co-evolve. And as in any evolutionary system, the combinations between the incumbent and the innovative that prove useful are the ones that are going to be selected. The result will not be the revolution that the CEO of BNY Mellon referred to. It will instead be a slow and steady process of convergence and adaptation, with most of the existing intermediaries and much of the prevailing technology infrastructure persisting. Even the optimists are not expecting tokenization to control more than 5 to 10% of global assets by the end of this decade. HSBC, in its recent paper on asset tokenization, predicted digital asset markets would be worth between 7 and 15 trillion US dollars by 2030. BCG had earlier come up with a figure of 16 trillion in illiquid asset tokenizations alone by 2030. Neither of those numbers amount to a lot when the global assets total may be perhaps 750 trillion US dollars. So we're talking maybe 2% of global assets. What I think we can be confident about is that tokenization will not remain so small that it withers and dies. Not because the Web 3.0 future that the blockchain embodies has deep social, economic, and psychological roots in distrust of centralized corporate institutions and personal data harvesting, although it does, not because the blockchain networks on which tokens are issued and exchanged are, like mobile telephones, not a product, but a platform that can support a wide range of providers delivering an even wider range of services, as well as a wide range of issuers, though it is that thing. But mainly because technology that underlies tokenization has improved, is improving, and will continue to improve. This is what incumbents, skeptics, and demonizers tend to forget about all forms of innovation. Technology is not static. The first muskets were not much of an improvement on the crossbow. The first tractors were not an advance on the horse. In the same way, it is tempting to believe that the halting of the ASX project puts the case against blockchain and tokenization in the CSD industry beyond discussion. But the reality is that the blockchain technology of 2023 has come a long way from the blockchain technology of 2015. Indeed, it could be argued that failing to take account of the capacity of technologies to improve and to standardize is the chief lesson of the entire ASX story. Today, ASX could have bought a tested blockchain off the shelf. There's no need to build your own. Besides, in Asia in particular, ASX was an outlier, by which I mean what's interesting about the Asian response to tokenization as a whole is that it is so well attuned to the co-evolving convergent model of adoption. In Asia, we see CSDs proceeding cautiously, content in some cases to let their exchange parents make the running. Unlike Europe, no CSD is building a digital facsimile of itself yet. We see regulators likewise responding creatively rather than conservatively, encouraging innovation and adaptation, but without putting investor protection or financial stability at risk. We see incumbents finding business cases in particular asset classes, notably bonds. Of the 19 Asian CSDs I looked at in preparing for this webinar, more than half of them have some sort of tokenized bond project in hand. Incumbents are also exploring service niches such as funds or stock loan, which they can occupy at low cost without provoking resistance, and from which they can, in theory, later expand. We also see many well-supported and, importantly, well-regulated startups experimenting with a variety of tokenization models. But if they're proceeding cautiously, Asians are also noticeably more enthusiastic about digital assets, and not just because of the potential gains in operational efficiency. Asians believe tokenization is a business opportunity as well as a cost saver. Now, to demonstrate that, we're going to begin with a short presentation from Barney Nelson on the activities and attitudes of participants in the Asian financial markets towards digital assets. drawn from the annual DLT in the Real World survey that he conducts. Barney is CEO at the Value Exchange, the market insights business he founded 15 years after 15 years working in post-trade services in Asia with BNP Paribas, Standard Chartered Bank, and Reuters. And after Barney's presentation, we'll have an open discussion, which includes you, the audience, in which we'll be joined by 4 experts, and they're experts not just in the Asian market of CSDs. Chris Richardson is CEO at Percival Software, a leading supplier of technology to CSDs, which has extended its offering from post-trade services to trading platforms. Percival is also the generous sponsor of today's event. Sriram Chakravarti is head of regulatory affairs and industry market node, the joint venture between SGX Group and Temasek that is building a complete blockchain-based infrastructure for the issuance, settlement, and servicing of digital assets, starting with bonds and funds. Francois Verlaine is Managing Director and Head of ASEAN and South Asia for Financing and Securities Services at Standard Chartered Bank, which he joined from JP Morgan 10 years ago. Kelvin Ung is President and Chief Business Officer at Fusang, which he joined last year, bringing with him experience of establishing a blockchain platform at CLSA, working at the Hong Kong Securities and Futures Commission, reshaping electronic trading at UBS, and bringing LiquidNet, the institutional dark pool, to Asia. Now, in addition to our panelists, as I said a moment ago, we also have you, our audience, and all 6 of us encourage everybody watching or listening to submit questions, comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. As always, I won't save those questions and comments up to the end, but we'll bring them up and encourage our panelists to address them as we go along, so everybody watching and listening can be an integral part of this discussion right from the outset. And with that, I will hand over to Barney Nelson to begin his short presentation. Barney, over to you.
Thanks very much, Dominic. And yeah, it's a real pleasure to be speaking with everyone today. So I think my job ultimately is to really just set the scene, I think a little bit, extending on what Dominic's been saying around, ultimately the landscape in Asia, feeding into a conversation between, as you say, Dominic, the experts who have far more to say on this than I do. But I'd really summarize the landscape of the Asian CSD kind of world in 5 or 6 key points. But what I'm going to run through, these points all draw on continuing research, as you said, DLT in the real world, which is a big project that we run each year with ISA. So all credit to all the people who have helped support us on that project each year. But ultimately, it gives us a statistical, very practical view of what's going on in the world of DLT globally, and therefore gives us the luxury of being able to support conversation like this about what's going on in Asia. Now, really, for me, the starting point of all of this is that DLT and digital assets are more important in APAC than anywhere else in the world. Now, one of the key points here really is that we know that the last few years have seen a surge in interest around digital assets. But the key point really is that from an APAC perspective rather, we've seen interest in digital assets continue at a higher level of intensity than anywhere else in the world. So, why does this conversation matter? It's because we're kind of talking about the epicenter of kind of global interest in digital assets according to the stats. So there's certainly we've got an audience from a market perspective. The key is what we're doing about it, and ultimately how that interest is manifesting into real transformation. The good news is that, at least from a statistical perspective, APAC is also distinguished in its focus on actually getting stuff done, which is one of the ways I'd always characterize APAC historically. But the key point really is that if you look at the kind of work that's being done in the digital asset sphere at the moment, there is, you can see, less thinking going on and more doing going on amongst Asian organizations of all profiles, so investors, CSDs, banks, brokers, and the resourcing that's going into digital assets and DLT is basically, as you can see, also continues to grow at a pace. So, I think there's an interesting piece here that you can see that the Americas are actually kind of taking, I suppose, a slightly they're very much in build phase, but ultimately it's really APAC and to possible extension in the Americas who are really driving the materialization of this. Now, of course, the key question is, why is this happening? How are these projects getting signed off, and actually where they're turning up? So how they're getting signed off, I think, is a really interesting one. And, as Dominic, you mentioned in your introduction, for me, the key point really is that on a global basis, DLT and digital assets, including crypto, the key driver of the business case for transformation has been essentially new products, possibly to new people. So it's product innovation. So, if you look at the overall game plan that we kind of map out each year, there's a kind of phasing, if you like, on a global basis from product innovation, self-serving product innovation in the short term towards market efficiencies in the medium term. But ultimately what we see in APAC is that actually that phasing doesn't really seem to be planned as much or as likely. And therefore, it's, the value of DLT and digital assets combined is essentially that it's driving our own P&L rather than necessarily creating a market effect. And that's really important, I think, when we come to look at the actual projects and the nature of projects that are seeing the light of day. Importantly, that idea of product innovation and driving new product revenues, actually one of the great questions that we get to ask each year is how are we seeing returns on investment? And for me, the two key standouts, interestingly, are that basically DLT is helping us to drive new product revenues as the number one, but also regulatory compliance, which is an interesting angle that I think will be good to kind of come on to later. But ultimately, what is DLT for in APAC? It's generally speaking more self-serving, I would argue, than it is about market efficiencies. Not that the two are necessarily exclusive. What does that look like from an asset class perspective? I think there's a few points here. These are the kind of leading asset classes that have been worked on historically, today, and then a look at the future. And I think, there's a few key points here. First is that, Dominic, as you mentioned, there's been a lot of experimentation with bonds. A lot of people have had a lot of goes with bonds for varying objectives in mind, which I'll expand on in a second. But ultimately, as we pass through the kind of current term, which is interesting, the securitized assets piece I find to be an interesting stat. But I think for me, the key point, as you can see, is that there's a wide range of assets emerging to the point where really looking ahead, there are three or four big areas where we're looking at digital assets really manifesting in APAC. One is bonds, especially the green finance space. Two is mutual funds. And then three is in the institutional space, kind of securitization and swaps. And so, for me, I think what's really fascinating, first of all, is that this is consistent with the global experience. As you were saying, we're still very much in the early days of the overall transformation of this, but there is a broadening of experimentation, a broadening of actual deployments going on across more asset classes. But obviously, one of the main things about APAC, given that it's 9 hours time difference wide and about 13 hours flight north to south, it's a pretty big zone. Realistically, the key point is to be able to dig into ultimately the constituencies that underlie this. Those constituencies can be viewed in one way, or one of two ways, arguably. One is basically is who they are, and then the second is who they're serving. In terms of who they are, I think, and back to the title of this whole kind of conversation, it is interesting that statistically, CSDs are the ones who are most actively engaged in trying to work on DLT. Now, there's a few hedges in the sentence for me, which is they're trying to work on DLT. This is work going on, not outcomes. And there's a key point there that I think ASX and others belie. But ultimately, the key point really is that, first of all, that exchanges and CSDs are actually driving the efforts in terms of it is, in a lot of cases in certain markets, a very centralized effort. If you look at ASEAN, if you look at North Asia, it's possibly even including Hong Kong, it is a centralized effort with others kind of going on. And it's standing very close to them are the banks. Who is not necessarily in the room and who needs to be brought into the room. The laggards, if you like, are the wealth and retail. And for me, there's a really interesting point in terms of consistent with the global research. What are we doing to get the ecosystem in the room and make sure that we can actually get everyone on board at the same time? Because ultimately, if this is going to work and we drive real market efficiencies, it's because everyone's working. The last point I'd make on this, which is a point of detail, but ultimately, if you look at what's actually how we're going about this, Dominic mentioned in the introduction this idea that you could now go and buy an off-the-shelf solution if you were the ASX. Interestingly, about twice as many CSDs and exchanges are working on their own builds than they are on vendor builds. And I think for me, there's a real key question in here about, first of all, the journey that they're embarking on as a CSD and exchange. And then second of all, are we making it unnecessarily hard for ourselves in the light of the ASX experience? So, is the idea of hiring a consultancy to do this, versus off the shelves, are we necessarily making our lives unnecessarily hard? So the last point I'd just drill into is ultimately, as I said, if you look at the APAC region, obviously it's very diverse, not only in terms of organizational profiles, but also, you always have the varying balance in every market between the institutional markets and the wealth and retail space. And for me, one of the key points that we're seeing more and more is an increasing focus, if you look at the projects that are coming through at the moment, on basically wealth and retail and bringing them into the room. And I'd argue that actually in ASEAN especially, a lot of the work that's actually successful is really in basically servicing the wealth and retail space. So on the institutional space, we do have a lot of work. You'll notice that a lot of the CSDs are absent from that in terms of actual projects that are kind of really, really there and going live. We have a very large industry replatforming problem across APAC in terms of legacy tech. Obviously, we have a continuing question in Australia, Hong Kong, other markets about how we're going to transition away from 40-year-old platforms to something new. But interestingly, most of the activity you can see here is either being driven by the MAS Temasek and or banks on the institutional side. So there's a really interesting, I think, there's a lot of activity going on, but ultimately, if you strip it back, it's running in a parallel path, I would argue, to some of the challenges that the institutional market faces in Asia. Where the really cool stuff, I would argue, is happening is green finance. We saw the Hong Kong, we've seen Project Genesis, and then obviously, the HKMA's most recent issuance a few weeks ago, really helping to drive out a kind of a green finance industry that's now spread, I suppose, just because of this year, we've got it going on in Hong Kong and in Singapore. You've got fund order processing, so starting to service that wealth clients and the retail client by automating order flows and automating registries in some of the hard markets. And then last of all, is very consistent narrative in the APAC region has been the fractionalization. So making essentially bonds and sometimes funds more accessible to individual investors, as we've seen in Thailand, as we've seen in Malaysia, as we saw in Hong Kong very recently. So I'd argue that if you string all of this together, DLT and digital assets, very important in APAC. Where is it manifesting? The CSDs doing a lot of the work and leading a lot of the experimentation, but generally with an eye on their retail participants and the retail and wealth who need to be brought into the room. So hopefully that sets the scene. As I said, very much, looking forward to kind of seeing reactions and views on that as we go, Dominic.
Thank you, Barney. And before I let you go and involve the other panelists, just ask you on one point of detail. Those blue lines on one of your slides indicated ICSDs and CSDs are pretty far advanced in their projects. A lot of the other things you said suggest that CSDs really in this area are followers rather than leaders. Is that because so many of them are owned by exchanges, or kind of waiting for the front end, as it were, to lead them, or is there some other explanation?
I think for me, well, one of the points of the global research that actually also resonates in Asia is CSDs are and exchanges, just given, if nothing else, the regulatory environment they sit within, they are very slow movers. Not because, you can cast as many aspersions about why, but ultimately they are moving much more slowly than an average bank, wealth manager, or technology company. And so, generally speaking, it's not necessarily that they're just sitting back, kind of waiting for things to happen. It's that they're actually trying to press ahead, but in quite a lot of cases. But it's just very slow work, given how, they are systematically important to every market in APAC. So therefore, the steps and the hoops they have to jump through are just so many more than any other provider, if you like.
We've already had a question from a member of the audience.
Yeah.
Himesh Patel has asked whether, he says, carbon credits, zero traction on any pilots at all. Are you seeing carbon credits in your data sets at all?
Yeah, I mean, it's an interesting carbon credits. Absolutely. I mean, obviously, you've got CIX in Singapore. You've had, Australia's been having a go. I think for me, the carbon credits market is definitely in build phase still. I think there's a great match in terms of the theoretical balance between what the ELT could do in that industry, but I would argue it's still in the experimentation phase in terms of actually real turnover not materializing yet.
Mm-hmm. Well, we're planning a webinar at Future of Finance on the carbon credit side, so I hope Himesh will attend that. Francois, could I bring you in at this point? You're in a good position to. We've been talking here very much from a sell side perspective. You're in a good position to judge where the buy side sits, I suppose, on this whole question of tokenization. As you go around the region, do you detect that there's huge appetite among asset and wealth managers for tokenized assets?
Yeah, it's interesting. That's what stood out for me in your opening. Who is going to make the case for tokenization? On the buy side, actually, I see very little demand. So I cover the region from India all the way to Philippines, and there's not one asset manager that I've spoken to that says tokenization is a high priority or even a priority of theirs. So this doesn't really come into the mix when they're talking about their investment decisions and their portfolio structure. Now, clearly they are typically relatively short-sighted in terms of the investment because it's all about returns over the next 6 months, over the next 12 months, and doesn't typically look further out than that. But to your point, I don't see the drive of tokenization coming from the buy side at this point. I guess there's maybe one twist to that though,
yeah,
which is one of the messages that I'm getting across the board is how do we increase retail participation? So how do we increase participation in the financial market? So you look at a Vietnam or an Indonesia with 100, 200, 250 million population, being able to tap into that retail side is fundamental for all the asset managers. And in order to do that, costs need to come down so that an Uber driver can automatically direct 2% of every ride into a fund or into an investment. Clearly, tokenization or blockchain and efficiencies will drive that. I see Chris is lifting his hand up.
Yeah. Well, Chris, that certainly explains the finding in Barney's data about fractionalization being important benefit of blockchain technology. Although you don't need blockchain to fractionalize assets, your broker could essentially do it for you. So, Chris, you wanted to say something?
Just a comment on human nature and the way the world works. The Uber driver hasn't got time. He's not going to sit with his mobile phone at a traffic light trying to handle his investments. And automation, 2%. A lot of the world lives from day to day. They work, and I'm talking not just the people on the street, working classes, but the white collar workers on tough jobs. It's hard to get extra time to be interested in investment. First of all, you need some luxury of time and interest to be able to do that. And it's an area about which the average person knows very little. And being naive in this game is not good, really. I have been privileged to be near and exposed to people who have tried their hands at trading. I can tell you, we are not all born equal. Some people just have a natural talent for it. And that doesn't always go with the necessary focus to keep your investment portfolio humming and humming until it grows. I know people who are really good at it, and they need talent and they need attention to keep it doing. I had one friend who was really good at it, but he got bored. He wandered off, and then his damn portfolio crashed. getting your retail investors, it's not just about, selling it to them. I don't see interest there in the vast proportion of the population. I really don't. That's a huge issue.
So maybe a stat there in terms of, in Indonesia, the minimum investment to buy into a fund fund was $1. Right now, you don't see many $1 investments.
No.
But the average was $10. Right.
Yeah,
So already that's come down a huge amount from what it was, say, 10 years ago.
that's one single investment. One single investment.
Absolutely.
Okay.
So to me, we're already seeing that increase in retail participation actually happen during COVID. And Indonesia is a great example of that, where you actually saw our volumes go through the roof. And I'm talking about tenfold increase in terms of volume as a result of that. So that increased retail participation is happening.
Perhaps it was an effect of COVID and being locked down and having your job threatened, that you thought, let me try this. This is something new. Maybe I can make money at it. I'm just thinking, yeah, in a normal world, you won't see that. I think that's a COVID side effect. I really do.
Anyway,
So it's still increasing. It's still increasing in Indonesia, right? And the expectation is that it'll double again this year.
Okay.
I'd like this retail point is a good one. I know, Sriram, I'm very keen to bring you in on the regulatory side, but I'm sure Kelvin has a view on this. But let me on the the importance of the retail investor in tokenization. But Giles Elliott has made a contribution here, which gives us an angle. One of the reasons that bonds had their traditional lot sizes, he says, was specifically to prevent easy access by the retail sector due to the sophisticated risk profiles of many of these bonds. How do we ensure that our enthusiasm for fractionalization doesn't cross some clearly designed primary market inhibitors for retail access? Kelvin, what is Fusang's attitude about the importance of retail? We've seen this surge of enthusiasm on the cryptocurrency side. Can that be built on the tokenization side? And what about Giles's point about the risk of a compliance accident occurring?
I guess the importance of retail, I think all capital markets are driven obviously from retail liquidity. And I guess in the traditional world, the instos and traditionals kind of crossing over in the traditional incumbent exchanges. Obviously, the promise of like the digital assets and cryptocurrency has shown you what massive retail liquidity participation could look like for an asset class. Unfortunately, what we've seen in terms of one of the big accidents is the question mark in terms of what are the underlyings of these kind of cryptocurrency products. And obviously, there's a general lack of investor protection in terms of assets available to access and trade. And a lot of the so-called centralized intermediaries that proclaim to be exchanges weren't really exchanges, and they were more like brokers pretending to be exchanges. So I guess accidents have been happening, very visibly over the last year. But the hunger, I think, for retail participation is really about accessing products and asset classes that they haven't traditionally been able to gain access to. I'm not so sure that purely just cheaper access to traditional products is the only part of inertia. It's really, it's like, does the retail investor have the right product selection in front of him? And does the retail investor even have the right education to know what to do with it if he did put it in front of him?
No.
There's a long journey before we get to the point where it's like retail is buying things that are more than just based on pure sentiment plays, which is what we've seen in the entire cryptocurrency market boom.
Well, it's not just that. If you look at it as an engineering structure, the problem with the cryptocurrencies is there's no negative feedback in it. All of those trades are mostly on emotional basis, and there's nothing to hold it one way or another. It's not anchored anywhere. Mm-hmm. If you've got an asset at an exchange that's doing its job, which includes making sure that there's proper disclosure by the issuers, that people can understand what assets they're invested in, that is some kind of anchor. to the price that will kill a lot of the volatility. But
Sriram, let's hear from Sriram on this, because actually it's a good entry point for him. I made a bold claim in my opening remarks that actually Asian regulators are getting this balance right between encouraging innovation and not putting retail investors at risk. So am I right to think, Sriram, that regulators in Asia, it's a big region, so forgive me for being so general in my question, but are they getting the balance right? Are they leading the token markets in particular? Put cryptocurrency to one side, token markets in the right direction.
So thanks, Dominic. Just to answer Giles' question in terms of whether there could be some bypassing of the retail restrictions. Now, there's a particular requirement under the securities statutes as to why there's different investor thresholds. So you have institutional investors, accredited investors, and retail investors. And like the point Chris mentioned, there are very specific disclosure requirements and compliance requirements that continue depending on which class of investors you serve. Now, you could bypass it, and I think there's a real danger of bypassing it and then going to retails with some fractionalized aspect. The danger really is twofold. One, in the sense that once, in case of a default or when there is a real issue, the retail customers, they then go and ask for some kind of customer protection. And obviously they don't have it because that wasn't applicable to them. And we've seen that particularly in the crypto space. And I'll give you two examples of that, which have happened. Now, firstly, just in Singapore, retail products, which were sold, even though there was no requirement at that time, and the regulators have come a number of times to do advocacy around the risks relating to buying cryptocurrencies. And then when you have issues like FTX or others, and then retail investors lose their money, then they have no redressal mechanism. And so what do you do? So MAS, the regulator in Singapore, obviously has come up with requirements that specify that certain investments, in this case cryptocurrency, should not be sold to retailers, should not be advertised. So previously in the Formula One races, you had cryptocurrency advertisements, all that have been taken off. You can't have ATMs around. So that's a risk that you have. I see something very similar in Hong Kong as well. Hong Kong has just come up with a consultation paper for virtual assets, for virtual asset platform providers. It's in fact just come in, I think, last week. And the idea is for non-security tokens, they want to have proper thresholds depending on which category you're servicing, what are the licensing requirements, what are the risks that are involved, and how do you mitigate those risks. So yes, there is that issue. And I dare say that I think probably on some amount of experience, particularly on the back of what we've learned in the cryptocurrency space in the past 2 years, I think the Asian regulators, at least speaking of Singapore and Hong Kong, are getting the balance quite right.
And if I may, just thinking about Giles's point reminded me of two key considerations that are probably on the minds of Sriram, the people that you're thinking of, is ultimately you still, Lehman's mini bonds were not all that long ago when basically people were queuing up in Hong Kong to demand their weirdly structured products basically back again because of the fact they wanted the Hong Kong government essentially to bail them out. And the second piece is China equities. From an issuer perspective, would you be happy having your capital basically be subjected to the kind of market forces that China is, in terms of a heavily retail market, 80-odd%, 85% retail, not intermediated at all? Those both, I would say, as examples of reasons for conservatism, I would say, in terms of actually how fast we want to be going down that retail path.
We've had a question from Eduardo Roa here, who says, what the answer has been from retail clients on tokenized bonds, because they've not been a common product for retail to buy. Which to my mind, Sriram opens up a broader question about how the tokenization market is, and you can confine your attention to tokenized bonds if you like, relative to what is going on in say Europe, where there's also interest in bonds, and the United States. I don't know whether you can shed some light on how retail clients are responding to this, but there's been a number of token issues around the world of bonds, and where do you think that is taking us? How well is Asia doing? How differently is Asia doing compared to other parts of the world?
Sure, Dominic. Maybe just let me share a slide that I prepared some.
Yeah, you've got some data. That'd be great.
Yeah, yeah. Let me share that, and I think that'll be useful. So, okay, are you able to see that on screen?
Yes.
Okay, so this is some data that I pulled off relating to primary market issuances. This is off the ICMA website. So they track essentially primary market issuances globally. And I pulled out data for from 2020 to 2023. So, so if you look at the rows, essentially, it talks about 4 years and the issuances, primary market issuances globally. Now, a couple of things stand out. The highlighted ones are essentially Asian, or the ones that have some Asian link. So you see Union Bank, that's Philippines. There's Singtel, OCBC, that's a bank in Singapore. Again, Union Bank. And the latest one in Feb 2023, which was, I think, a week ago, which was the tokenized green bond issuance. Couple of things from this chart. Firstly, they're not that many. I mean, you can count those. I think you're probably talking about 25, even if I missed some, probably about 50. A number of these are pilots. So these are not pure issuances. So if you really look at issuances, it might be about half would be real issuances. The rest are pilots. What, however, is interesting is while the graph goes up from 2020, 21, and 22 in terms of issuances, again, not much in terms of quantity, 2023 is really surprising. We're just 2 months into 2023. Well, we're now into March, but essentially 2 months of 2023, and we've had about 5 issuances. All 5 are real. So these are real issuances, as in these are real transactions. And you look at the size of them, they're fairly good sizes. So you've got you've got 100 million City of Lugano, you've got the latest EIB 50 million digital bond that came up. You have the Siemens one, which is again quite exciting because this was on a public blockchain. And then you've got the Hong Kong offering, which is Hong Kong 800 million. So again, pretty good. The Hong Kong one is particularly interesting because it is about green issuance. I think there was something about carbon credit previously. So there's about green issuance and tokenized bond, and it's a real offering, a live offering. Very interesting in terms of the structure that was done. It was done to Hong Kong law, again, a first, and for a government to be able to do it. The question that you asked, Dominic, is in terms of Europe versus Asia. My sense, just looking at this data, is that Europe is leading in terms of issuances, but I think Asia is quickly catching up. I know at least of quite a few projects in the works that should come up in 2023. A lot of people are talking about 2023 being the year of tokenization and issuances, so I think it'll catch up quite quickly in Asia, as well as I think in terms of deal sizes. The other point I think, Dominic, worth mentioning is just in terms, I stopped share that particular slide, but just in terms of the infrastructure and the regulatory aspects that I follow quite closely. And I think Europe is definitely leading there. So in March, you got the EU DLT pilot regime, which allows you to do a sandbox regime for issuances. And I think quite a few issuances will come out of that. UK has the FMI sandbox, again, something that will come into play this year. And what I'm seeing very interestingly is what the stock exchanges are doing on the backs of legislative approaches. Germany with the EWPG scheme, the DLT Act, the Blockchain Act in Luxembourg, Switzerland, etc. These are pretty exciting and they give certainty, something that in Asia we still don't have. The other development, I think, as far as Europe and probably UK are concerned, is in terms, especially UK, is the amazing work that's been done by the UK Law Commission in terms of helping clarify certain aspects of tokenization, whether it be smart contract, whether it be recording on a DLT, whether it be just token issuances, title transfer. And 2 weeks ago, the UKJT came up with a statement that said the English law is flexible and accommodative enough to accommodate tokenized bond issuances. And I think these are very encouraging signs. My own sense is a lot of issuances were held back, or interest was stymied primarily because the legal and regulatory aspects were not clear. And I think with that aspect getting clearer, with greater clarity around those areas, I think more issuers will take comfort, especially institutional investors who've probably been on the sidelines will probably now be more keen and sure of coming up with issuances.
It's a good point about the work of the UK JLT. On top of that, there have been a number of court cases, some I think in Singapore, Sriram, as well as in London, proving that cryptocurrencies are property. And if you extend that to tokens as well, which you can very easily, that creates a great deal of legal room, legal certainty for people to start issuing these tokenized bonds and others. And perhaps, Sriram, but before I let you go, you could help us take the discussion forward a bit about, if you've just explained that Asia is catching up on Europe on bond tokenization, but if and when tokenization starts to take off, as it appears to be doing in the bond area at least, what the impact of that is going to be on CSDs of Asia. And when I looked at those 19 Asian markets and the CSDs and looked at the type of assets which they're servicing, I found 100% of them service corporate bonds, 75% of them service government bonds, only 90% of them actually service equities, and it's 75% on funds as well, and an even lower proportion, 65%, supported alternative asset classes, those privately managed assets or securitized assets, which Barney referred to in his presentation. So this is not something which incumbent CSDs can ignore, is it, if bonds start to take off? And to what extent do you think the incumbents are doing enough? Clearly at MarketNode, you're doing a lot on this area, but as you look across the region, do you think that other CSDs, other market infrastructures are doing enough to facilitate the rise of tokenized bond issues?
I think tokenization itself is quite a narrow construct, Dominic.
Mm-hmm.
I think you've got to look at it a bit more broadly, in terms of what various CSDs/exchanges are doing across Asia. I think definitely there's a thrust for efficiency. I'd give you an example of what MarketNode's doing, and I think it wouldn't be too different from what others are doing. I think it's also been featured in Barney's slides. We are across three product categories or business lines. One is essentially into the data play, where we're looking at both providing data as a subscription, both offering issuance data as well as green data in the form of ESG, and that's in a platform. We also provide workflow automation. This is for essentially the documentation and bringing the issuance on board. So that's the first aspect. The second is really in terms of funds, where we're putting together a funds processing utility. This is for public funds initially, but the aspiration is to move into private funds. And that's, again, an efficiency play, but with an opportunity to be a utility and to bring about significant efficiencies, not just in the market, but overall in the economy. And the third one is really in terms of tokenization post-trade and what can we do. That's part of our being part of Project Guardian and things that we're doing. And I think this would be similar to what other CSDs are doing. I think it can't be tokenization itself, the way I see it, is quite commoditized. That's a small part of it, but it's really getting that end-to-end. And how do CSDs get that end-to-end, both from the point of view of bringing the issuance all the way to if either tokenized or in traditional systems, but bringing efficiency into the process. 2 years ago, we worked on a project with HSBC. It was one of our first projects. It was a pilot on that deal. And the amount of efficiency that we could bring just by virtue of digitizing the process, bringing the whole life cycle on chain was significant, close to 60% efficiency that we could bring about. Now that's on one deal. Imagine if this could go significantly higher across various deals. So I think that's the real play, and we're definitely seeing those across the board. In fact, you might be aware, ADB, the Asian Development Bank, has a project that's looking at bringing about security settlement across ASEAN +3. And it is looking at, the prototype is essentially looking at how can CSDs help with the efficiency in terms of security settlement and what can be done, not just internally, but across borders. So quite a bit going on in that space, Dominic.
Thanks, Sriram. I'd love to hear what Kelvin thinks about this as well, but Francois, perhaps you could give us a sense of where you see CSDs investing, as I'm kind of probing here what the impact of digital assets, more broadly conceived, as Sriram has pointed out to us, are likely to have on CSDs, and what areas you think CSDs see this new technology being useful for them to invest in. Is it settlement? Is it registration? Is it, I don't know, securities financing? Is it funds? What do you see if you travel the region?
So I don't have an answer for you. And the reason is I don't know where all of this is going to land. In as much as if we have a digital marketplace with a digital CSD with tokenized assets, what is the role of the various intermediaries that exist in today's value chain? What is the role of the custodian in that value chain? So I'm not sure. I don't have an answer to you. I think, can a custodian and a CSD coexist? Not in today's way of working, because some of the roles become redundant. And therefore, how does one or the other change the way it does things? So as a custodian, do you go more up the value chain, and do you manage more on the repo side or the margining side or the collateral side, and provide services around that rather than your traditional safekeeping and settlement? So
do you not think,
go ahead.
Francois, if I may, just very quickly, do you not think that the APAC region breaks down into ultimately what the CSD is trying to serve? Because I was just thinking, as you were saying, you've got the institutional exchanges where basically Hong Kong, Singapore, Australia, Japan, and I'm missing one anyway. But the big guys who are majority institutional, and then everyone else who's majority retail in terms of their focus. And wouldn't that drive the product mix, if you like, and therefore the investment?
And I'm curious, which way do you think it would move? Do you think it's more on the institutional side or on the retail side? So take, I don't know, India, a fairly big retail market. Actually, I'm not seeing a huge amount of traction there, and maybe Sriram can shed more light on that, versus a Singapore and Hong Kong, which is more on the institutional side. So maybe there is something there.
Well, okay. Technically, a CSD is a very specialized kind of custodian. You can look at it that way. Now, I know markets where the two of them coexist, and the conflict between them is whether the custodian wants to fully employ the services of CSD in a kind of, technically some kind of participant or service user, and to expose his client portfolio within the CSD system. They're capable of doing that. Usually the reaction is, no, I don't want to do that, because they're guarding their liquidity. And there's a lot of liquidity, there's a lot of transactions that go on inside the custodian, and not just custodians, but other market players, stakeholders. They traditionally brought value-added services to the mix, so they give advice to the naive investor. And quite frankly, your Uber driver might prefer to invest via an institutional, some kind of institutional or market player who handles his portfolio for him. And I don't think that's going to go away.
So I'm just thinking that generally speaking, what we see in the digital asset space, and I guess I've been on this journey my first foray was in 2017 into private equity on the blockchain as an institutional player. And what we can see right now in 2023 is effectively all these broker-sponsored platforms or bank-sponsored platforms, right? So the infrastructure is clearly not there for everyone to commingle. And the role of the CSD then is like, well, hey, what do I do right now when you guys don't all talk to each other? And all these single experiments, every platform has done one bond issuance. You're like, oh, we're in the very beginning stage of the internet in terms of traditional finance on the blockchain. And we're probably not even past the first innings is where we are right now. And because there's no infrastructure, we're all experimenting with like, what is the right framework for everything to interoperate? And I think where we've been fascinated with the blockchain experiment is when we can see everything interconnect in the cryptocurrency space without friction, and it's borderless. And obviously it has some other problems from a AML, KYC, and just being able to regulate the endpoints. But once you can see the assets flowing, you're like, wow, this digital blockchain thing, really amazing. So I think we're quite far away from that. I remember my first project in 2018, I tried to sell it to every bank. I failed dismally because no one was ready. We had 3 years of COVID, which I was pretty bored and and hid away and then resurfaced. And I'm like, wow, 3 years, fast forward like 3-4 years on since I tried to sell that platform, the banking infrastructure is just getting the plumbing in. They're like, we're just starting to do security token custody. so we're so far away from the eventual future version of the markets. I think a lot of the incumbent industry is just kind of waiting to see who's got best ideas and which version kind of is sticky. And then the traditional national stock exchanges, there's not much motivation there because the real revenue is really all about the today and now capital markets.
Yeah.
That replumbing job is expensive. There are so many expensive failures along this way, and I'm sure we'll see quite a few more. That they're lack of monetary motivation to move forward. The interesting thing hearing from Francois is the lack of interest from the buy side, and I think that ultimately one of the angles which is going to probably drive the buy side is just making sure that there are products that they have to access via this new infrastructure. Otherwise, they can't invest into it. So I actually do think that things like green finance, sustainable type investing is going to be the key to unlocking digital assets for traditional finance on the blockchain. And it's going to be really interesting seeing how that moves forward.
Yeah, but basically you're saying you're forcing people down that route who have a vested, mainly emotional interest in one kind of asset. And people don't like to be tied down like that. Most of your investors are looking, do I have to do this? No, I'm not going to do that because I don't trust it. Because there have been plenty of news stories where people's portfolios have just gone.
Yeah,
lots of bad press, huh? And it doesn't matter whether it doesn't apply to your specific asset type or your particular token because of X, Y, or Z. It creeps over, bleeds over.
Yeah, but it's not isolated to just like digital assets, right? So in the securities world, we have securities fraud, and obviously in Hong Kong, our regulator, the favorite job was clamping down on sponsor fraud and lack of due diligence on public. Right. So
we've had some interesting questions coming in. One from Harvey Lowe on private equity, which I'd like to come to second. Adriana Hinao's question here: do any of you know a CSD that has participated in a tokenized bond issue or in a pilot? And Kelvin, I'd like to put that question to you because I've been thinking, listening to you, if you were advising a CSD on what they should actually do about tokenization in terms of which asset classes will be affected, which client types will be affected, which service areas are opportunities and which are risks for them, what would you actually say to them? But maybe you could deal first with Adriana's question. Do you know of a CSD that's done any participating in tokenized bond issue? You may also know the answer to that, Sriram. I don't know. I have an answer which I can tell you, because I think that I have seen, if I look at the CSDs I've looked at, which have gone into bonds, the Hong Kong Monetary Authority has been involved with a its money markets unit on a green bond issue. The Bursa Malaysia depository has also been involved in POCs on bonds. The NSDL in Asia, in India, the Philippines have, and
Thailand as well.
Thailand, yes.
Yeah.
And Singapore, of course.
Yeah.
So yes, we do. Taiwan as well. So yes, lots of them have. Yeah, Adriana. Yeah.
It seems like the uniting feature of all of those examples you listed was that they've got much deeper pockets than most of the CSDs around the world. Well, it's good that they're investing experiment, and they need to do that, need to diversify. I get it, but smaller CSDs don't have that luxury, Dominic.
But these are efficiency plays by these CSDs.
Yes.
They see the primary market particularly as being very inefficient. And Sriram mentioned earlier that 60% savings they saw in Hong Kong. So this is an example of where blockchain technology really adds value.
But the regulation cramps it. You could do IPO through private placings on an exchange and just let the market run its course. You could do that. I don't see many examples of it happening. Technology is not holding it back. It's regs.
Anyway, Calvin, you didn't answer my question about how you would advise a CSD, and how should they respond? What should their strategy be?
You're going into my day job, I guess.
Yeah.
So, how would I advise the CSDs? I mean, it's challenging for them right now with regards to how they should participate. The interesting piece of infrastructure, which is kind of almost like an unknown force in terms of digital assets, is what's going to happen with institutional CDBCs, right? That's going to be an interesting play. And then also the other side is regards to what is going to be the repositioning and the role of these CSDs in these other marketplaces, including our own exchange, right? In terms of the whole settlement and clearing infrastructure. So whilst you've got the blockchain kind of crypto version where it's almost like cut out all the intermediaries and go direct, certainly our view at Fusang is we don't really believe in that you can actually disintermediate all of the intermediaries and just go issuer straight to consumer. And certainly I think the reason why there's a lack of motivation from the incumbents to do anything is it's like all brokers that make a commission. I don't want to get cut out of the transaction. So at the moment, there's a bit of inertia from shifting from where we are today to this kind of dream version of the future of blockchain. And I actually think that the future of traditional finance in digital will look actually a lot more similar to what we're used to seeing in traditional capital markets. It just hasn't quite made its way there yet because of the slightly hodgepodged regulation and guidance from regulators with regards to lack of clarity of what you can and can't do.
I agree.
And I think as we get clarity on which tokens are a security and which tokens are a utility, and I'm not sure that the term cryptocurrency will exist for too much longer, because it'll probably be one or the other, then you'll get much more clearer platform plays with regards to what people can do. And then the participants and partners of those platforms will become, I think uncannily, they'll look a lot more like the people you're used to seeing in traditional finance, but obviously with the efficiency plays and benefits that you get from the blockchain.
Okay, can we address Harvey Lowe's question now, which is, how do you think DLT tokenization can be used in the context of private equity? We hear a lot about privately managed assets as an opportunity. It's clearly an area where tokenization can be used because there isn't really a competing infrastructure for them to go up against. I don't know whether Sriram, you have whether you've come across that as an issue. We have seen ADEX in Singapore has made considerable progress in tokenizing private equity and hedge fund real estate strategies, hasn't it?
Yeah. So at MarketNode, of course, we're dealing with the public markets, so not that much in terms of the private market, but I do keep tab in terms of what's going on. In my previous life as a private practitioner, I used to be a funds lawyer, and I can tell you the number of clients who came in essentially wanting to do tokenized funds or used tokens for distribution. significant, and I would think that that interest hasn't gone away, because the challenges are real, because you have a closed-end fund, or you're locked up for a significant period of time. You can't sell out, you can't liquidate, and so the option is, can tokenization help in that sense? It could, and players like ADDX are obviously at the forefront of that, along with many others who are trying to solve that problem. The opportunity is significant, but I think it does have some pretty big challenges. I think one is in terms of transfer. How do you do that, and how do you value? I think so. It's a data play as much as an information that needs to go in. So you've got to value these assets. You've got to find a ready buyer. You've got to have that kind of a platform that allows for secondary sales to happen. I think the pieces are coming together. I think there's a coalition of the willing that's coming, and I track them regularly. My sense is it's still early days on that front. I think with bonds, sorry, just to finish, I think with bonds, etc., it's just so much more easier. Also, just wearing the legal hat, because you've got none of the statutory requirements that come in when you have kind of private equity or venture capital with LLPs or the Companies Act requirements, and then you have transfer issues, tax issues that you need to take care of just beyond what you have with bonds, etc. These are just contractual claims, much more easier to deal with them, much more easier to kind of negotiate and transfer them. So I think that's a point.
Kelvin, just I'll come to you back to you in a minute, but Francois, just very quickly, are general partners of private equity firms bashing your door down, demanding that you tokenize their funds?
I can't say they are.
Your door looks very shut. Yeah.
Yeah, absolutely. So, look, I think to me, it feels like an obvious place where it would have had a lot more traction, and yet haven't seen a huge amount.
Okay, Kelvin, you wanted to say something on this point. Are you seeing activity from private equity managers?
I mean, in my first guys, obviously, I looked at private equity, and it's one of the hardest ones to tokenize with regards to what rights do you have as a token holder. So that's already really, really messy. And quite often it doesn't have a cash flow attached to it. So no coupon payment or cash flow. It's like, what do I do with this token? So it's this extra layer of complexity, which nobody really wants, right? So that's actually one of the harder places to kind of play with regards to tokenization. But I do believe eventually it will get there. It's just not quite ready for selling yet. Said that Fusang's own equity is tokenized on the Ethereum blockchain. So all the shares of our company are actually are actually ERC20 tokens. The other areas which I think are going to be interesting, I do think that these private equity funds and are going to be interesting for tokenization. And I do think that's an easier distribution story. So we do see GPs coming to us saying, how do I get access to liquidity, right? Because the GP sitting in Europe, it's like they have this vision of like Asians have lots of money, and they're like, I don't know where to go. And then when you look on the map, Asia's clearly not one country, it's quite big. So that kind of like the dream of accessing Asian distribution or global distribution, I think that's enticing for GPs, but there's no real market infrastructure to do some of this right now, at least not easily. And most of it is, if it does exist, is fairly new. And then obviously there is some question marks with regards to the legality or the testing of the legality of these pieces of infrastructure, right? None of it's gone through any court case as such. And most of the court cases are actually about cryptocurrency theft or fraud. So it's we're quite a way away from making this real, but there are some material experiments you can see already across the whole region. And I think certainly the bond space is one of the most obvious spaces where you can start to test existing legal contracts, which effectively is some form of term sheet that's in token form, and then the distribution channels can be built around it. So I think 2023, 2024 is going to be really interesting, certainly from an Asian perspective. I can see a lot of focus going into this space. But are all the Are all these projects going to end up commingling and cross-connecting? I think there's a huge unknown here, and we're going to have to wait and see.
Dominic, if you remember from our earlier webinars, really good ones, that one of the problems that's plaguing the whole process is standardization, interoperability. Need it, man.
Yeah.
If I may, just we've just finishing off some research on exactly your point, Kelvin. I think for me, there's 2 points that actually follow on, I think, really nicely from what you're saying. One is that it's hard to break out of the retail space at the moment for private equity. So private direct issuance to retail is reasonably straightforward because they're, as you said, legal structures are not so probed. And second of all, ultimately, there's much less need for data disclosures. But when you start actually, when people want to be able to price risk in a sophisticated way, it's very hard. There's the platforms don't exist yet to be able to communicate the kind of deal room data in a smooth way. The other thing, though, that's really surprised me in the private equity space is the value of the shareholder relationship. So those who have succeeded have, consistently say that the real driver in private equity is the ability to actually really engage consistently and on a more bespoke way between the issuer and the ultimate investor. And that visibility in a world of ESG, shareholder governance, stewardship, and everything like that is kind of rising to the top of the value. So I think exactly to your point, there's a huge amount of value in it. It's just a question of how do we move away from retail and actually get into where the real money, well, it's not that retail's got no money in it, but into the more liquid spaces.
Barney, I don't know whether your research tells us anything about this, but we're probably getting to our last 5 or 10 minutes now. But Eduardo Roas asked another question, which is, what's the most common way to work on B2C solutions? Is it internal developers? Is it collaboration with technology partners or some other mix? And are they working with the same roles or changing the business model? So let's say you want to use tokenization to reach retail investors. I don't know, you're a bank or a wealth manager. What's the approach that you're seeing? I'm sure Kelvin's got some advice on this too, but Barney, does your tell us anything?
We do actually. Fortunately, it's Eduardo's hit the nail on the head actually for one of the key. So what we've seen in the last few years is basically two journeys. One is functionally everyone when kind of the whole kind of blockchain phase kind of kicked off. First thing that all the banks and a lot of people did was go and buy part of a VC share in some small fintech. And basically it was very much start with share ownership and then basically cultivate a platform within your shop. So Citi, JP Morgan, a lot of people did that. I mean, ASX owns a part of digital asset, for example. And what we've seen is the shift across actually through the technology now to the first thing that you do on a global basis, but also in Asia is the first thing you do is get the room of the ecosystem. And then, so basically go back to basics, get the problem solving, and Market Node's been very systematic on this. Diagnose the problem, explain the problem, size it with the ecosystem in the room, and then ultimately move on to technology. So we've seen this shift in the last few years of technology leading the ecosystem to the ecosystem leading the technology. And the other thing, just very briefly, is who do you turn to? APAC, I mean, even before DLT, is a massive self-build region versus Europe and North America, I'd say. And it shows through in the numbers that basically APAC is if people are doing one thing at the moment, it's you call a consultancy to build your blockchain for you and your app for you in APAC. If you're in Europe, you basically get it off the shelf. So it's a really interesting distinction there, I think.
Kelvin, have you got some advice for Eduardo other than come join Fusang, join our network?
He can phone us. He can come and license our technology if he really wants to. So obviously we have a B2C solution for our exchange license anyway. But ultimately it's really hard for anyone starting a B2C securities solution right now because the regulatory regime is changing so fast. So you will actually need quite deep pockets to go and get any form of market operator license and to get all infrastructure up and running. So in reality, you probably want to license your tech rather than build it from scratch, especially if it's a trading platform, because you only need certain types of order book matching to do certain types of transactions. And then, like the question is do you want to build your own blockchain or not? And I guess the answer is it depends on who's supposed to be on it, right? So it really depends on what you're trying to do. For typical B2C solutions, most of the infrastructure you're trying to build in Lego brick pieces across the electronic trading industry already. We built this in the last 20, 30 years, and it's exactly the same stuff. The only thing that's fundamentally different is the whole settlement mechanics of any digital asset. But when I was doing this in 2017, 2018, it was very expensive. Now it's very cheap to license that same technology. So I wouldn't try and build it from, I wouldn't try and build everything from scratch unless you really can't find a purpose-built solution already.
Now, we must stop in 5 minutes, but I'd like to use some of that time just to explore what seems to me some strategic initiatives we're seeing in the region. The Monetary Authority of Singapore has launched this Project Guardian, which you alluded to earlier, Sriram, to explore the potential of asset tokenization, not just asset tokenization, but decentralized finance, DeFi, as well. We're seeing something similar in Korea, where the regulator, the Financial Services Commission, is legislation, and it's clearly looking to the exchange and to the CSD in Seoul to support issuance, registration, trading, custody of tokenized assets as well. Sriram, you're in a good position to answer this question initially. What should we expect from these? What's driving them, and what should we expect from initiatives of that kind? These look to be quite high-level, strategic-driven tokenization initiatives.
I think the aspiration can easily be gleaned from a speech by the managing director of the Monetary Authority of Singapore in August 2022, where he said, no to cryptocurrency speculation, but yes to digital asset innovation. And the key line there was, he believes, and this probably is the policy angle, is that tokenization and DLT could put together could be a very strong combination from an economic point of view, quite similar to the securitization wave that we saw a few decades ago. So that's the angle, really. But to get to that point, I think a lot of innovation and regulation, as he himself said in that speech, has to go hand in hand. Guardian, that you alluded to, that we're part of, the first phase of Guardian was really about exploring DeFi construct or DeFi protocol and applying that to traditional finance. Quite a luring prospect, especially given what the DeFi protocols on the crypto side have been able to achieve with the amount of money that's locked in. And if we could bring that with appropriate guardrails, and hence the name Guardian, to traditional finance, it's a punt that could work, and it could work very well, because of aspects such as liquidity pools, automated market making, price discovery, etc., with distribution. Now we're working on Project Guardian with two very large banks, really on a structured note. It's an efficiency play to a very large extent in terms of the time taken for issuance of structured note, but it's also about distribution in terms of whether through tokenization we can actually use public blockchains to increase that distribution network. One point that I always bear in mind is my young nephew who goes to university, who buys cryptocurrencies and has moved away from buying stock exchange other than the Robin Hood episodes. And his point is, why can't I buy treasuries and I can't see all my security holdings and asset holdings on my wallet, on my crypto wallet? And they're so used to it. So perhaps there is an evidence of where the future lies. And if that is the future, then I think projects like Guardian are angling towards that promised land.
Mm-hmm. Francois, some final thoughts from you. Do you feel that initiatives of this kind, like Project Guardian, which build these guardrails and attempt to draw, regulated institutions into creating a safe infrastructure for digital assets, it's something which in Europe, where regulators seem much more reactive than proactive, do you feel you're living in a region where actually the regulators and the private sector are working hand in hand to build a digital asset marketplace of the future, however long that takes?
Absolutely. I mean, you're looking at MarketNode as an example of that. That said, I'm going to twist the question somewhat. Is there a space for the traditional space to continue and actually leveraging this new technology in the traditional space and to drive efficiencies there? right? Because when I look at how quick are all these changes likely to happen, and we're talking about 2% of volumes, or 5 to 10%, I think you quoted, by the end of the decade. In a decade's time, what are the efficiencies that could be had in the traditional space which outweigh the benefit of moving to a digital ledger? So I thought I'd just throw that out there as a either a delay or actually this not happening.
But it sounds, I made an assertion in my opening remarks about the consensus now is that the traditional infrastructure and the digital infrastructure are converging. Is that what you're describing there, do you think? Do you see evidence of that?
Well, I guess converging in as much as there's pockets of the traditional space that leverages DLT. And that in itself is driving efficiencies. Now, I don't think you'll get to a space where but could it totally converge? I'm not sure. I think can you drive the traditional space to slowly integrate various components of that value chain on a blockchain? Possibly. Which ultimately you get to the same outcome. I do believe that, look, you've got two parallel universes going forward right now. Ultimately, there will only be one. How we get there, I'm not too sure. Kelvin.
So I'm just curious what the rest of the panelists think in terms of one of the areas I struggle with the most is T0 settlement as opposed to T+2. I'm like, how do we get to connect the two worlds?
Yeah, 100%. I was just thinking, actually, as Francois was saying that, for me, the big challenge is ultimately, I mean, you know, as an intermediate step, you've got the US T1 move. And what's so fascinating to everything that we've been saying is that DLT statistically is not on that path. I mean, we've seen it. People are not with their feet or even with intention choosing to look at blockchain because it's too slow to implement. So I think the challenge is that you've got these two parallel paths for the next few years, Francois, as you say, I think is you've got change going on right now, old world change. And at the end of the day, digital assets are on a parallel path at the moment. They're not converging, as in this isn't offering up solutions to urgent needs. And so if the two stay parallel, the question, well, how long do they stay parallel? I guess.
What's the difference, Barney, between settlement on T+0 and atomic settlements on a blockchain? Is that not a point of convergence?
No, sorry, I mean in terms of actually it happening. I don't know. I don't disagree with the fact that it's there. I just mean that basically that the move from T2 to T1 in the US and Canada, even that we're not using any. I mean, there's very little use of blockchain to help us get to that, which ultimately blockchain would help us overshoot. To your point, if that makes sense.
And I guess we've had we have this live experiment in the US, and we've had a live experiment in China. In reverse,
India, T+1,
and India too. Yeah. Anyway, we must stop in a minute. So I just thought it would be good just to give the audience something to take away from our discussion today. But before I ask that question of you, I'd just like to thank Michael Smith for his observations here. He says on carbon credits, which were raised earlier, we can add air carbons getting set up in Singapore and Abu Dhabi. The CEO is Thomas McMahon. We should all take a look at that, and we'll, as I said, be visiting that in a future webinar. He's also pointed out to Adriana, who asked that question about CSDs involved in bond projects. He's reminded us that SDX has in fact issued 2 bonds on its S2X digital exchange and settled them in its digital CSD as well as its traditional CSD. So that would, Adriana, be a very good project for you to look at. Okay, so now a last thought from each of you on where all this is going, I suppose. And we've begun to talk about it. Are we going to compete? To Barney's point here about at the moment we're on parallel tracks rather than converging tracks. If you look, and I don't think you should look more than 5 years ahead. Do you think those tracks are actually going to start to converge? Do you think, Kelvin, that Fusang is going to overtake SDX and Hong Kong Exchange, or is it going to continue on its own course?
5 years, this is a very distant dream, I think, to overtake the Hong Kong Stock Exchange. But certainly, I think our opportunity set is obviously we're a new exchange. There's very few new exchanges that materialize in capital markets. We don't have any legacy, so it's like, what asset classes can we plumb in that is effectively a low-cost access solution to investment products that maybe are not interesting for Hong Kong Stock Exchange or even Singapore. So that's kind of, I think that where our market positioning is going to be. But in 5 years, I still think it's like the points I raised earlier about lack of infrastructure for markets and whether we all unite in one place. I'm wondering if we will have answered that question by then or still be figuring it out.
Sriram, do we need to, just a last word from you, do we need to figure that out, that point of convergence, or can we just carry on as we are and see what happens?
I think the markets will figure that out. I see the Swiss experiment is very interesting. You've got a digital exchange and you've got a traditional exchange, and the digital exchange is getting traction in completely new ways. But I think there's a healthy level of convergence that's there. We see it between what we are doing at Market Node and our relationship. Of course, we're very close with the exchange and with the CSD for things that are very small. So an ISIN number, we've of course got to go to the CSD to get that, for example. And if we follow something like a traditional listing or a technical listing, then you would essentially go and do that on the exchange. So I see quite a bit of that a symbiotic relationship going forward. And my own sense is in 5 years, I think quite a few of the Swiss experiment you'd see many more iterations of that.
You could fix that issue with the ISINs by having two NNAs in a single country.
You could, yeah.
And restricting that, put something in the ISIN structure that was separate for tokenized assets, so that there would be no collisions in the ISINs that were allocated. It's solvable.
We looked at one point where we could get a few ISINs to ourselves, and then we give out those ISINs. So block ISINs.
Well, essentially it's the same thing. You make sure there are no collisions. But
that's right.
Yep.
In advance.
Well, that doesn't sound terribly satisfactory if the same asset is available on the traditional exchange and the digital exchange.
Yep.
That's primarily because we're looking at doing bonds at this point of time. But as we go forward, I think there'll be quite distinct asset lines that'll come across.
Okay.
If it was a purely tokenized asset, it would originate in the tokenized world, and that would be the source of truth. And that could be traded on a traditional exchange, except they'd have to use your ISIN now. Nothing wrong with that.
Okay.
Well, we think that'll be traded on a public blockchain, so you would not need that at all.
Not only, you can't control where things are traded.
Okay, well, we haven't time to go into native versus non-native digital assets at this point. Francois, I don't know whether you want to give us one final thought on the question of parallel tracks versus convergence.
Yeah, so I think that it will carry on parallel tracks, and I think it's the more illiquid assets that will go onto the digitized, and once it gets proven there, then potentially there is a conversion. But absolutely, I don't see it going any other way for certainly in the next 5 years, where there'll be two parallel, the traditional and the digital.
Mm-hmm. Barney, it falls to you to give us the last word. I'm surprised that we're still talking of parallelism here rather than convergence as we come to the end of this webinar. Does that imply there will be a competition to the death, or is this just a delay to convergence?
I think, honestly, as Kelvin said, this is a long game. Yeah, and ultimately, DLT and blockchains and everything are just another answer to a set of problems that we carry every day. And I think it's just part of the toolkit. And over time, people will use that toolkit in the same way that they're using centralized databases, APIs, whatever. And so we will, the creative amongst us will come up with solutions that then people will copy. But it's a long game. I think the CSDs, other than, as I said, where it's self-serving, I think the CSDs will be quite a long way down that path, other than in kind of either self-serving or, as I said, a little bit operational areas.
And our audience has some thoughts on this still before we finally go. Michael Smith tells us that DTCC and R3 have announced today parallel settlement of 100,000 transactions a day. Martin Watkins has pointed out you can arbitrage between a conventional and tokenized asset if they have different ISINs. Another reason not to like those two national numbering agencies. As he points out, if the tokenized security is cheaper and more fungible, then the arbitrage will add a premium to the price. So thank you, Michael. Thank you, Martin, for those observations. And thank you also to all members of our audience for your many questions and your many comments. I'd like to thank our sponsor, Chris Richardson from Percival Software, our presenter, Barney Exchange, and our panelists, Kelvin Ung from Fusang, Sriram Chakrabarti from MarketNode, and Francois Verlaine from Standard Chartered. I know all of them probably stay at work rather later than they would have liked, so many thanks to them. Here at Future of Finance webinar will take place in 3 weeks' time on Thursday, the 23rd of March, to be precise, also at 1400 London time. And in it, we will be exploring CBDCs again, in particular, when we expect a major currency to issue a CBDC. I hope that many of you will join us then, but for now, it's goodbye from the